Hi. This episode with Grant Griffin is going to be dynamic. So I invited Grant on the show, Insurance VC, PE, and MA. And he was like, let's do it. I was like super excited, right? So not many people know the investment banking side of how they involve themselves in the venture capital side and also the M&A side. And Scott brings so much knowledge working with the VC parties, the PE parties, the founders, the MA, the sellers, the buyers. Anyways, just a lot to unpack. And this show is going to be dynamic. So I hope you enjoy. Hello, welcome to the show. This episode of Insurance VC, PE, and M&A. Today we have an awesome guest I have known for a while. Today we have Grant Griffin on the show. How are you, Grant?
Doing great, Jeff. Appreciate you having me on.
Thank you very much for coming on. Our show is going to be not just about your story, but also education piece about everything in the insurance world and everything about venture capital, PE, and just deals, right? Mergers, acquisition. And today you sit in the third part of that show, the mergers and acquisition side. So what I want the audience to get to know is get to know Grant. You had a great career over at your company, Sherman Company, and you have moved up from the company, and now you are VP of investment banking at Sherman Company. And I want to educate my audience on what do you do every single day, right? And then also what led you to this world of investment banking and how you fell into insurance investment banking. So if you can give our audience, the backdrop, and that'd be great. And I'm going to turn the mic over to you.
Absolutely. And I'll work backwards from your questions. So, growing up, my grandfather and father had a retail insurance agency. So I spent my summers, sitting in the attic, throwing away paper files 7 years or older, right? And so was quickly exposed to the insurance industry. And when I was in college, I was able to intern with a MGA for several years, which was a fantastic experience to get into the underwriting of the industry. But when I was in undergrad, I was like, no, I will not follow the path. I'm going to pave my own way, and decided to go into bank consulting. That wasn't for me, went straight back into insurance. And I think what drove me back into insurance was the people. I think the people in the industry are fantastic to work with, to be around, and everybody's so friendly, focused, and there's a lot of fun had. But fell back into insurance, and it was a management liability underwriter at Star, and Travelers focused on large private and public accounts, and started, I had a mentor at one of the carriers I was working with who had pushed me to go back and get my MBA. He was working on his third master's degree. So I went back and started graduate school and fell in love with the finance side and knew I wanted to go into the banking aspect, but also wanted to leverage my prior experience. And that's how I stumbled across Sherman Company, was, researching FIG and insurance focused investment banks. So that's, what got me from insurance to investment banking.
How was that first conversation like? Who did you meet first at Sherman Company? And what was that one thing like, yeah, I'm going to apply here? Where did they recruit you? What was that like?
So I had cold reached out to Lawton Sherman, who gave me a call. And, initially it was a call about the job, my role, what that would be doing. But unfortunately at the time, they didn't have any, open slots. There weren't any seats at the table. So they ended up calling back a couple months later and, had another great conversation, brought me in. And I think what I fell in love with was the M&A aspect of work. We work mostly with founder owned and led businesses, as well as some private equity backed and strategic, but you know working with these founders, seeing how they built these companies into what they have today, and then helping them realize what is a transaction of a lifetime for them. So taking them and, being the Sherpa to them from the start of a process to closing is, a really rewarding experience. And I was very much attracted to that, as well as, being at a smaller firm that was a little more entrepreneurial.
One thing I noticed a difference because I have been around the space for a little bit, that there are people hired straight from investment banking world into the investment banking. And then there are people who hire from the insurance world and into the investment banking. What do you think was your strength that allowed you to thrive with the insurance background? And what do you think was your challenge? Like, what was the hardest part about, the challenge walking in that door and walking to the seat?
Well, I think our firm, Sherman Company is a little bit different. We like to say that, we're insurance people in investment banking and not investment bankers in insurance. So we've got a lot of our team members have been in and around insurance for decades. So it gives us a better insight because we've sat in those seats. I've, been at a retailer. I've sat in the underwriting seat. I'd actually worked at the MGA I had interned with. I had used that same system, and we ended up helping the owner and founder of that AMS system sell the company. So it gives you a better insight into it. But what I thought was I could really leverage experiences with talking with brokers, negotiating, rates, really understanding the day-to-day from underwriting to claims and how distribution worked. I could, it really helped me shorten the learning curve because I knew how the insurance ecosystem was connected. And I knew, sitting in the seat and having a new buyer, we look at the market and try to figure out where this fits. Maybe it's a tech asset, or maybe it's a retailer or an MGA. So you have to think out of the box to really drive that additional value that these owners deserve. The learning curve with any banking job is, it's trial by fire just about everywhere. So you got to jump in with both feet, hit the ground running, and that means doing some little lower level stuff, but really, that's kind of the foundation of which you build upon. Maybe that's sending out all of the distribution deals, and then you start to learn and you see trends. So, it seems that benefits are starting to trend a lot more, or we're starting to see, specialty on the rise, which we've seen in the last, 2 years. So, the things that were very difficult at the beginning and that were a grind were what I felt built the foundation to help propel myself and help the firm close. We've closed 550 million plus in enterprise value in just 3 distribution deals this year. So we've had a strong year on that front.
So I'm going to dumb just some of the questions down for our audience, make sure that they are all following you, because this is very fascinating in the world of M&A. If you had to talk about your journey, right? Like your journey from meeting a potential founder who is thinking about selling for the first time, what's your longest curve deal? Like from the first conversation, hey, I'm thinking about selling Grant, and to go to the deal transact, right? And what was your shortest one, if you had to guess?
So the shortest one was, there was a prior relationship, but it was about 12 days from, it's been years since we had spoken, but it was 12 days since our reconnect to signing the engagement, which is the shortest because sometimes we have relationships with some of these owners for 10 plus years before they're ready to sell. So the sales cycles are typically on the longer end, but sometimes, you find the right situation, find somebody ready to go. But a deal process can take anywhere from 5.5 to, as long as it takes. So, maybe you have I think the longest is maybe a year and a half, but that was due to some, macroeconomic circumstances that, drove us to the altar, pulled back, and then went back to market, finding a different buyer um, at what was a much greater valuation and a much greater partner to the seller. And then I think the fastest was, one we had this year, which was right around 5 months. But the process, the longest part of the process and the most variable is typically after you sign the letter of intent and go into exclusivity with one buyer and to close. So in 2021, there's over 1,000 transactions in the distribution space. And people were, just land grabbing, buying as much and as quickly as they could at great multiples, by the way. And, as interest rates rose, capital became more expensive and people had already acquired these businesses, they started to do a little bit more diligence. They learned, oh, we didn't, we just acquired this group as fast as we could. We should have looked at this. Maybe the growth wasn't as strong there. But the diligence has gone from what was maybe 45, 60 days at the quickest to averaging more 60, 90, depending on the buyer and the situation, of course.
Which side do you guys represent more, the seller side or the buyer side?
So we spend about 75% of our time representing sellers and then 25 representing buyers.
Okay. So hypothetically, if I'm the seller, right, and I am insurance agency owner, right, and I have built my babies over time, over 20 years, hypothetically, 3 million revenue, and I'm ready. How does that conversation look like in our first meeting? Like, what am I responsible for? How does this process work? How do you prepare me?
Sure. So, when a seller is ready to go to market, we'll have conversations because first and foremost, it has to be right timing for the seller. Um, you know, a lot of these deals, they're they're very time consuming on the management team and the owners, and you have to be very upfront with them about that. You got to know they need to know that this will be demanding, and we do everything in our power to take everything off that we can. So, we make sure they have a really good understanding of the process. We talk about buyers who they might like to see and talk to, and buyers they might not. And then we would get, once we get started, create some marketing materials upon which we would send to the buyers. Something short and sweet. Don't want to give away their trade secrets, right? But you just want to give enough to strike conversation, and so it's the beginning is a little bit of a rush. So if you think about the time spent by a seller throughout a process, it's it flows up and down, right? So at the beginning it's a lot. We need a bunch of data. We need to get approvals on the marketing materials, the buyers they'd like to speak with, some legal documents, and then it'll kind of mellow out as we bring everybody, as we go to market, and then bring them back in as buyers start to get serious and want to have conversations with the owner. And so it's, we just always try to make sure there's a great understanding of what will be required of them, what they should expect to be providing throughout the first couple stages of the process, and that timing in terms of first round bids and second round bids and going into exclusivity.
So let's just say I end up with multiple bids, right? And how do you walk me through 80-20, 85-15, 70-30? Like, first, those of you guys listening, we're talking about cash versus stocks, right? And then how do you present the options when it's like more established stocks, the value there, and also a new PE entering the space offering their shares. You get to give them a very low valuation. How do you present the pros and cons to an agent, and also the earnouts, right? What do you see normally? Like, what do you see most common as how people structure earnouts? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
The split between cash and equity on a transaction is going to be dependent on the buyer, and then the scale and size, as well as the length, management's intention to stay. So somebody who's looking to cash out may be looking for a lot more of that up front, as opposed. So having that understanding going into meetings with buyers, we want to tell them to tailor their offers to what the management team wants. Now, when you get, an array of offers across, different splits of equity upfront, maybe, earnout, which contingency payments based on, certain either revenue or EBITDA metrics. That's a little bit trickier because, these private equity backed strategic retailers will have a price set on their stock, right? And they'll have a multiple at which you'll enter. So if you're transacting on a $10 million deal, then it's 80-20. So you're getting $2 million worth of stock, at the multiple of which they're trading. If they're at the top end of the market, we don't like to see that. We want them to think about themselves very cheap. We want them to be giving great valuations to owners. And so we break that down for owners when they're looking at this. So, that would be a very different situation with a private equity backed strategic than it would a private equity firm. So the strategic is typically going to buy 100% of your company and roll 20% in their stock. And, they may have different classifications of stock, but we like to see either, just one classification or, maybe two, but one is just voting shares as opposed to the other. The more classes of stock, the more complicated it gets, and valuations get a little hairier. But if a private equity firm is going to come in and they're going to buy 80, or let's say they buy 60% of your firm, and then you retain 40% of your own firm, and they may provide some sort of equity, like management equity incentive plan. So, you would have a chance to get more equity going forward. But what they're going to do is, they're going to buy you at X multiple. They're going to hope to grow that multiple 20% minimum year over year. And maybe they inject some cash. So maybe you're a platform and you make an acquisition under you. Well, owners need to realize that more equity will go to the private equity firm because they're going to be injecting more cash. So sometimes you'll see somebody come in with a minority deal, maybe at 40%, but they know that over the next 5 years, they're going to put in another 50 million. And so maybe they go from 40 to, 45, 55, but essentially you have to look at what that management's equity value could be going forward at the growth rate. And typically, we've seen some great, some owners in some really big transactions make 3, 5, 10x on the minority equity over the cash payout.
10x on minority equity over cash payout is amazing. That's a good day.
It's really interesting, and it's a phenomenal way for management who wants to stay on, especially to get a second bite at the apple and really, take some chips off the table. Taxes could be going up, so a lot of people are thinking about what 2026 will look like from a tax year, and so people need to be cognizant of, oh, I can get this at the capital gains rate, and then I can be part of a bigger organization that is likely to scale faster than I am alone.
Talk about earnouts. What do you usually see in earnouts? 1 year, 2 year, 3 year, 5 years? If you had to break down the percentage of what people put in earnouts, where what are the time that there's 0 earnouts? What do you see?
Typically, we see, we're need that understanding with the management team up front, because sometimes, typically what we see is 2 to 3 years minimum of a transition period. 3 probably being what we see the most of. But there are situations, we've had a situation where there was someone who was pretty much retired, right? The founder, and had passed it on, passed the reins on to somebody else, and they were taking that company and really exploded. And, he was cashed out 100% of his shares at close, the founder. And then the new president was the one who got to retain, the earnout and the equity on the go forward basis, because they want to incentivize this, the management team going forward. And they really want to, push you to be a part of the growth story that they're trying to create. So we'll see, earnout structured, if the earnout's $10 million, maybe sometimes it'll be 2 million in the first year, 2 million in the second, and the remaining 6 in year 3, right? And then sometimes it'll be kind of an equal weighted, all 3 years have the same metrics. If you hit, typically it's a growth metric. So if it's based off of EBITDA, it'd be typically something along the lines of everything above the base rate of 10% of growth on the EBITDA will be multiplied by X, or will be, they'll give, maybe it's just a threshold. If you reach this threshold, then you get this amount of cash. So it's structured very differently everywhere. So there's no hard and fast rule, but we try to make sure that the EBITDA or the earnout thresholds are very reasonable, and most of the buyers do as well. They want you to hit your earnouts because they want you to grow and build with the company. So they, a lot of times they don't want to give you something outrageous, but we have seen some high growth earnout thresholds.
So the next question is, how often are these earnouts capped versus uncapped if you had to put a percentage next to it?
Oh, most of them.
Most of them are
Majority
uncapped?
No, most of them are capped. And there may be situations where, if the owner was a large producer, maybe they still get a portion of commissions. And there's a lot of different structures that people would, you can get creative, right? But after the cost of capital raised and people saw how big some of these earnouts could get because of the rate increases over the last couple of years, most most places have some sort of cap, and some of them are really high and some of them are pretty reasonable. Maybe, I've seen some at 1x of closing EBITDA. I've seen some at 5x closing EBITDA, or just a flat threshold or cap. Excuse me.
Go back to earnout. It's fascinating to me, so I'm gonna keep on asking questions, right?
Sure.
You're representing the audience out there who's thinking about selling it, right? So, by the way, if you want to follow Grant, I'm gonna put all the links in the comment below, so this way that you can follow Sherman Company, you can follow Grant, connect with Grant, and then if your company have a contact form, I'll put in the comment section, and make sure you hit our link button. Make sure you hit our subscribe and like this episode, so this way that we can get Grant's episode out there more. Go back to earnouts, right? So, how often is earnouts is done in equity and share splits? We talk about the exit, right? The exit splits of cash and equities. What about earnouts? How often do you see the earnouts split in equities and cash, and what do you usually see the splits are?
For retail agencies, it's fairly rare to see an equity component in there. You typically will see the equity components maybe in a pure private equity deal. You're buying a platform, and they, I mentioned earlier the management incentive plans. So maybe there's 8% over this period of time that they want to allocate as management hits certain thresholds. But typically the equity split will be on the upfront transaction. So, that's where you're going to be negotiating your equity. And it's a little bit different of a situation too, because, with equity in the earnout, if there's different tax implications. So maybe that, you close in year 0, the transaction, and you retain, 10%. And 3 years down the road, the company that acquired you trades so that you can liquidate some of your assets. Well, hitting that 2-year mark on the initial share percentage may change the tax implications than if you were just to receive the shares. And it's in different formats for different sort of company structures, but essentially the earnout, equity and earnout is rare to see on retailers these days, unless you're a very sizable retailer. Typically, in anything under, there, definitely 10 million most of the time, you're going to see 100% buyout. Maybe it's an asset deal where they bought and they just give you 100% cash, especially if it's just a book deal. But if it's, if they do give you equity, it's 100%, and then they put you in their class A of acquirer stock. So, I think the earnout part is absolute gravy for a transaction and for an owner. And it should be something that you should hit, right? It's a lot of these owners are making 500, 750, $1.5 million a year because, they're just taking in all the profits. But when you're acquired, you're going to normalize your salary. So maybe you go down to 350 or 500. And so those first 3 years, that earnout component is really helping you get back to that normalized, but hopefully higher than normalized income level for you, as well as the cash up front and then the long-term equity.
So, more questions. We saw everybody in the marketplace in 2020, 2021, and everybody think the M&A world slowed down a little bit in 23, 24, right? And then how I see the marketplace, there's 3 type of typical buyers. You have your, Acrisure of the world, big brokers that's backed by PE, right? And then, you split that up into incoming PEs who are getting into insurance funds, And then the second bucket of buyers are your existing insurance agencies, right? Who are great leveraged by banking. And they can buy smaller size deals, right? And then the third bucket is interesting bucket to me is your fintech companies, right? So when we saw 2020, 2021, we saw Experian purchase Gabby, right? We saw some of those fintech deals. I have a prediction. I want to run it by you. I think there's going to be a lot more fintech players coming, like Credit Karma, NerdWallet, Loan Depot, those type of players of the world, whether they're digital wallet, mortgage companies, dealerships. And then I think there's one more list of buyers, like your, Allstate that bought insurance and Answer Financials, Farmers that bought 3 independent agencies. One of them is Craft Lake. What do you think about the predictions of fintech companies and then also the insurance carriers get into the fixed model of operations?
This is a great question, and we've done a ton across the insurance tech and services. 32 deals. Whether it's AMS systems, D2C. It's really an interesting space, and we're starting to see the space, a maturation of the insurtech space. You're right. 2021, so many transactions, and if you go back to those transactions, a majority of them are kind of the private equity backed strategics. But more recently, especially if you look at it on a deal value basis, the public companies have really come through in the last year and a half because the cost of capital, they have the big balance sheets and the cost of capital is up. So the private equity groups aren't as acquisitive, but you started to see the public brokers, Marsh McLennan, which you saw the $7.5 billion transaction, I think, announced yesterday with McGriff. And you've seen Brown & Brown over the last couple of years spend billions on acquisitions, and Aon acquired NFP. And so it's, there's a transition a little bit in the cycle. But I think right now we're hearing the most we've ever heard about carriers and the digitization of insurance. So, we've seen some of these groups, that are a little bit more fintech focused, thinking about getting into the insurance side, right? So, maybe you have somebody like a lending tree who is lending to a small business. Why would they not be offering a small business policy along with it? Or, when you go to a car dealership, why doesn't you just sign your insurance papers there? And you've seen a push towards that. And there's a couple of companies that are focused on trying to really drive, a little more tech into these insurance products, just make it quicker, easier. But the adoption of D2C has been, it started to tick up, but the biggest issue over the past couple of years was the retention. People did not like not working with people. They didn't have anybody to call. They were calling call centers, and there was a big barrier between the insured and how what made them feel comfortable. Because that's what insurance is, right? It's a risk transfer agreement. As the insured, I'm transferring risk for coverage and peace of mind. So with that, it's there are certain things where I'm very happy just to click a button and go ahead and get it. But I think this new generation that's coming up is very focused on, what app do I use? How can I just get this done? They're not as focused on the people to people aspect. So I think there's great opportunity. I'm seeing a lot of really interesting technology be pushed. And I've seen a lot of fintech, companies, or they've come to us and been like, this is an interesting play. We'd like to get in to this area or this line of business. And so, we've had buy sides where that's been the case. And it's interesting to see how they think about it. Because if you go back and you look at the success of different insurtech companies, some of the ones that we've seen be most successful have been people who are in insurance and solved a problem that they knew was within the ecosystem, or they knew that customers needed better customer service here. The people, the number of some of the Silicon Valley tech guys going, oh, this is a archaic industry with a lot of legacy technology that has a lot of room to grow. First, it's a slow moving industry, but second, if you don't know the intricacies of the regulatory requirements or how it works within the ecosystem, it is truly a relationship business. So Jeff, at this point, I think the opportunity is down on the lower end of the market, on easier to write business and easier to distribute business, like small bot policies, smaller commercial, so personal. So it's interesting to see the developments, and I think there's a great push towards that. But coming from the underwriting side, underwriting some of your largest blue chip companies out there, there's such a relationship aspect, and growing a book of business profitably is very difficult. That's why these insurance companies are so old. I mean, they're behemoths, but they didn't grow at 500% year over year for a couple of years. They grew on a very thought out, sometimes profitable approach. So it's interesting, and I think there's going to be a little bit of a conversion between insurtech and fintech. But I think where they can really play is tooling brokers, tooling carriers at this point, instead of trying to disrupt, the insurance model.
So when a seller comes to you, they've been running insurance their whole life, right? So you need to put resources around them, I'm assuming. And what percentage of that is done in-house versus like third party? Do you say, hey, we provide attorneys where you got to go get your own attorneys? Can you talk a little bit about the nuances of those things, attorneys, valuation, and accounting CPAs to clean up their book, right? And also like valuation, do you guys do that in-house? Ask third party to jump in when there's tech involved? What does that look like?
So, if they don't already have an attorney that they like to use, we will suggest some. But typically, it's dependent on what the owner would like to do. Everything else, we're going to do in-house. Or maybe they have a bookkeeper, and sometimes things aren't as organized as, some people would like them to be. We've gone in and helped kind of organize and get things ready to go so that when a buyer comes in, we provide the financials that are accurate and easy to follow. But typically we're doing, all of it in-house outside of the legal requirements. So we're doing our valuation in-house. We're, coming to you with what we think the market looks like. So maybe we right size what the market is and, pick some buyers that way. But everything will be in-house up until you get to exclusivity. So when you start doing due diligence with the acquirer, they will bring in third parties. So one of the reasons that is such a grueling process is typically they're going to do what's called a quality of earnings, or known as a Q of E, where they're going to do a financial and operational diligence, and they will comb through financials, comb through operations, employees, payroll, make sure everything matches. And, that's a very grueling process. Then they may bring in a tech consultant to do some diligence on your technology. And maybe they bring in, and that would be not as much on a retail agency side, but the technology side. And maybe they bring in somebody to approach some of your customers and get a customer quality diligence. So, and then legal, would kind of finish it off, but that, that is purely the legal team. We will assist, but we stick more to the negotiating than the language writing. So it's, there's a mix of people that will be involved in the process, but when somebody is engaged with us, we lead them, and the legal team is, support, and it's just us. We go get it done.
Is most of your customers in US based, Canada? Are there any in Canada, or are you guys primarily focused on US based?
Sure, we sold a company called Benicade to April, and that was April's entrance into Canada. We've sold a couple companies based out of Ireland, UK area, but a vast majority of everybody we've worked with on a seller side is US based. But we're agnostic. It's we have 17 people, so we find that it's much easier to travel within the States than it is to go overseas at this point. But we've worked with mostly North America, UK, and Ireland.
You throw Ireland in there. So now I'm curious, do you guys do any deals out of the UK? Like London area?
Sure. I mean, we've done 89 deals across almost 12 billion of deal value. So there's been a lot of different companies that we've worked with. So for instance, on the tech services side, we've done some buy side work for Davies, which now has a US headquarter in Nashville, but at the time did not, right? And so we've worked with several international buyers or sold to international buyers. So when you think of our domain, our sellers are typically North America or UK, but our buyers are worldwide.
Do you guys also do raising money support? PEs and VC raising money, building funds?
So, we purely focus on M&A transactions. We've done some capital raising in the past, but that is our bread and butter. And then insurance is our bread and butter. For the last 20 years, this was an insurance focused firm when it was founded in 2004, and continues to be the focus today. Built out a couple of different other verticals like wealth management, healthcare, but we stick to what we know, and that's mergers, acquisitions, cross insurance, and wealth management, healthcare.
So if I have you on the podcast, back from the podcast a year from now, any comfortable and uncomfortable goals for 2025 for Grant?
Oh, of course, always aiming high. Would really like to 2025 we believe is going to be a strong year of M&A. The distribution space multiples remain very frothy, and owners, there's a lot of older owners out there. There's a lot of agencies that are out there as well that are kind of some may be belittled by some of the consolidation of these bigger shops. There's been admitted market pulling out of certain states for the last several years, and carriers aren't giving out appointments like they used to be. So, some of these groups are struggling, but we think it's a fantastic market. Looking at the public valuations, they're very strong. Looking at what we think is going to be a strong Q4 of M&A is going to curtail into the following year, especially with taxes, potential raise in taxes on the horizon. So, to me, this is a second chance for the sellers who didn't go in the 21 era, around there, because we're seeing a strengthening in the market, and there's a limited number of quality groups out there. So the quality groups are really getting great valuation and finding great partners. So I think next year this year for us was a record year. And so
Congrats on the record year.
Yeah, it's been fantastic, but I think next year the goal is to exceed that and, try to get as many tombstones. Unfortunately, this year we've had a lot of deals just go undisclosed, but we've been very active in the market. So I'd love to see, a handful of deals for us on both distribution, tech services, as well as the other sectors where I don't spend very much time.
Well, those of you who made it through this episode, I really hope you enjoyed it. I enjoyed it. And Grant is very easygoing. He's always easy to talk to. And I have brought him referrals in the past. Or, if you ever think about getting into the M&A world, Grant started as associate, now as a VP. So, I'm sure their firm is looking to grow, and he'd be excited if you hit him up. And those of you who enjoyed this episode, make sure you go follow and connect with Grant. So thank you very much for joining us. And thank you, Grant, for coming on the show.
Thanks for having me, Jeff. It's fantastic.
All right. Have a good one.